Have you ever wondered how to make your money work for you rather than the other way around? Welcome to the world of mutual funds, a financial tool designed to do exactly that. Imagine a group of investors pooling their money together like a potluck of funds, each contributing to create a large investment portfolio. This is the essence of a mutual fund. Now, this pooled money is not just left idle. Instead, it's put to work. It's invested in a diverse range of securities, from stocks and bonds to money market instruments and other assets. The idea is to generate income or grow over time, much like planting a seed and nurturing it to bear fruit. You might ask, who manages these funds? Well, that's the role of the fund manager. Think of them as the chef of this financial banquet. They decide what goes into the pot, making calculated decisions based on market trends, economic conditions, and the fund's objectives. Their expertise is a crucial part of the mutual fund's performance. Mutual funds come in various flavors. Some focus on equities or stocks, others on bonds or fixed income securities, and some offer a mix of both. Depending on the approach, each fund carries a different level of risk and potential return. So, whether you're a risk taker looking for high returns or a cautious investor seeking steady income, there's likely a mutual fund that matches your appetite. But here's the best part. By investing in a mutual fund, you're essentially buying a slice of this diverse portfolio. This allows you to own a variety of investments that might be difficult or costly to acquire individually. It's like having your cake and eating it too, but financially. So you can think of a mutual fund as a basket filled with different types of investments. It's a tool that allows your money to work in diverse fields, aiming to harvest profits. Whether you're new to investing or an experienced player, mutual funds can be a valuable addition to your financial strategy. Now that we know what a mutual fund is, let's dive into the different types of mutual funds available. First off, we have equity funds. These are the daredevils of the mutual fund world, focusing on stocks with the potential for high returns. However, they also come with higher risk. Equity funds are further divided into categories based on company size, the investment style of the holdings in the portfolio, and geography. Next, we have bond funds. These are the conservative cousins of equity funds, focusing on fixed income securities like corporate or government bonds. They're generally less risky and provide regular income, making them a favorite among those looking for stability. Then there's money market funds, the safe havens of mutual funds. They invest in highly liquid, short-term instruments like treasury bills and commercial paper. They're low risk and provide modest returns, but they're a solid choice if you're looking to preserve capital. On the more adventurous side, we find sector funds. These funds invest in specific sectors like technology, healthcare, or energy. They offer high growth potential but also come with increased risk due to their lack of diversification. Balanced or hybrid funds are the chameleons of the group. They invest in a mix of equities and bonds, balancing risk and return. They're a good option if you're looking for growth and income. Index funds are the mirror images, designed to track and replicate the performance of a specific index like the S&P 500. They're passive, low cost, and provide broad market exposure. Finally, we have fund of funds. These are the mutual funds of mutual funds, investing in a variety of other mutual funds. They offer diversification and are managed by professionals. Each of these types of mutual funds has its unique objectives and strategies, offering a world of investment opportunities. Whether you're looking to grow capital, generate income, or preserve wealth, there's a mutual fund for you. Remember, no matter what your financial goals are, there's likely a mutual fund out there that can help you reach them. But how do we choose the right mutual fund? That's where analyzing mutual fund performance comes into play. Imagine you're in a bookstore, surrounded by countless books. How do you decide which one to pick up? Perhaps you read the blurb, check the author, or even skim through a few pages. Similarly, in the vast world of mutual funds, analyzing performance is like reading the blurb of a book. It helps you make an informed decision. Why is this analysis so crucial? Simply put, a fund's performance significantly influences your investment returns. By scrutinizing different funds, you can identify the one that aligns best with your financial objectives and risk tolerance. Now let's break down the key metrics you need to consider during this analysis. First up, we have annualized returns. This metric gives you the average annual return over a specific period. It's a useful tool to compare funds with different lifespans. But remember, past performance is not a guarantee of future results. Next, consider risk-adjusted returns. This shows the level of risk associated with the return. A fund with high returns might also come with high risk. This metric helps you understand if the returns are worth the risk involved. Then we have the expense ratio. This is the percentage of assets deducted each year for fund management and other expenses. Lower expense ratios usually mean more of your money is invested, potentially leading to higher returns. Finally, take note of the portfolio turnover. This indicates how frequently the fund buys and sells securities. A high turnover might result in more trading costs, which can eat into your returns. By carefully examining these metrics and aligning them with your personal goals and risk tolerance, you can make a wise investment decision. Remember, the right mutual fund for you is one that matches your financial objectives, risk tolerance, and investment horizon. It's not about chasing the latest trend or highest return. It's about finding the right fit for you. So, by carefully examining these metrics and aligning them with your personal goals and risk tolerance, you can make a wise investment decision. Analyzing mutual fund performance can be rewarding, but watch out for some common pitfalls. In the world of mutual funds, it's easy to be swayed by the allure of high returns. However, focusing solely on past performance is a common mistake. Yes, past performance can provide insights, but it's not a reliable predictor of future returns. So, don't get caught up in the dazzle of high historical returns. Instead, consider other factors like the fund's expense ratio and portfolio turnover. These metrics can significantly impact your potential returns. Another pitfall is the temptation to chase trends. Just because a particular sector or fund is currently performing well, doesn't mean it's the best option for you. Trends can shift rapidly, and there's a risk of buying in at a high point only to see the trend reverse. Remember, what goes up must come down. So, rather than chasing the latest hot trend, focus on building a diversified portfolio that aligns with your long-term goals. Speaking of trends, let's address another common mistake: trying to time the market. It's an enticing idea, isn't it? Buying low, selling high, and making a hefty profit. The reality, however, is that timing the market consistently is near impossible, even for seasoned professionals. More often than not, attempts to time the market result in buying high and selling low, the exact opposite of what you want. Instead of trying to outsmart the market, a more sustainable strategy is diversification. By spreading your investments across a variety of asset classes, sectors, and regions, you can mitigate risk and potentially enhance returns. Diversification doesn't guarantee profits or protect against loss in declining markets, but it can provide a measure of safety in volatile market conditions. Avoiding these pitfalls will not only save you from unnecessary losses, but also help you build a robust portfolio. Remember, the key to successful investing in mutual funds isn't about chasing the highest returns or timing the market. It's about understanding your financial goals, assessing your risk tolerance, diversifying your investments, and staying the course. So you're now equipped with the knowledge to analyze mutual funds, but how do you choose the right one? The answer lies primarily in your personal financial goals and risk tolerance. The first step is to clearly define your objectives. Are you saving for retirement, your child's education, or a dream vacation? Next, consider your risk tolerance. Are you comfortable with high-risk, high-reward investments? Or do you prefer a slower but steadier growth? Your financial goals and risk tolerance will guide your choice of mutual funds. Another key aspect is asset allocation. Spreading your investments across different asset classes like stocks, bonds, and cash equivalents can help mitigate risk and potentially enhance returns. Finally, don't hesitate to seek professional advice. Financial advisors can provide personalized guidance based on your unique financial situation. Remember, the right mutual fund for you depends on your personal financial situation and goals. Choose wisely and let your money work for you. So, what have we learned today? We've journeyed through the dynamic world of mutual funds, discovering their essence as financial Swiss Army knives, offering a variety of investment options tailored to diverse goals and risk levels. We've understood the importance of performance analysis in mutual funds and how it can significantly impact your investment returns. By meticulously evaluating key metrics such as annualized returns, risk-adjusted returns, expense ratio, and portfolio turnover, you're empowered to make informed decisions to maximize your financial goals. We've also discussed common pitfalls to avoid, like obsessing over past performances and chasing trends, instead emphasizing the importance of building a diversified portfolio aligned with long-term objectives. Finally, we've explored how to choose the right mutual fund, starting from defining your objectives and risk tolerance, considering asset allocation, and seeking professional advice. That's all for today's ProsperFin TV episode. If you found this helpful, comment and share, subscribe and hit the notification bell for future updates.